going?
Good. How about you, Megan? Happy Tuesday.
Happy
It is Tuesday,
Tuesday.
right?
It's Tuesday and April 1st is tomorrow, which is wild because,
Yeah,
yeah,
right.
what a weird year so far, really. Um,
Mm-hmm.
things have taken a little bit of a twist here in the last 2 weeks with real estate, I
Mm-hmm.
think, because of the
Mm-hmm.
increased mortgage rates and fuel prices and that sort of thing that
Mm-hmm.
we got a little consumer uneasiness, and I found that over the years, when there's a sort of a rift in the market, it takes a few months for things to find its new level.
Yeah, it always does. It comes back though.
Yeah, yeah, like they say, water seeks its own level. That's also true of the real estate market. That things always even
100%.
out to what people can afford.
Yeah, I mean, look, we're still in good shape. I mean, no one could anticipate the events of the past month or so. It's been 33 days, I think. Um, things happen, but it's not. I guess it's temporary, and we just roll with it.
Yeah. Well, what else are you going to do? Can't control it.
Yeah,
So let's talk
right.
about a
That's what I say.
very interesting conversation today. Well, it's
Mm-hmm.
interesting to me anyway, because a lot of people don't know when they look online about this and that sort of thing. So we're going to talk about a little C word called concessions. Concessions.
Mm.
Concessions are sort of a trade, a situation for money, right?
Mm-hmm.
So it could be
Mm-hmm. Mm-hmm.
we had an inspection and there's repairs that have to be made. So there's money exchanged in return. That's a
Mm-hmm.
concession.
Mm-hmm.
And
Right.
sometimes if buyers want to pay their interest rate down, or they've got some closing costs, or even paying their own realtor, there is a concession from the seller.
Mm-hmm.
I was looking in the
Oftentimes.
MLS. I was getting ready for a listing appointment the other day, and I saw a sale, and it was really high. It was like really high sale. And I was like,
Mm-hmm.
what the heck? And I always look to see what the concessions were. So on this particular one, I screenshot this to save it for today.
Okay.
The concessions were 25,000 for financing, 60,000
Okay.
for improvements.
Okay. So 60,000 for financing?
No,
Financing concessions?
25,000 for financing,
Oh, 20, I'm sorry, 25,000. Okay. Gotcha.
60,000 for improvements, 33,375 for the realtor, closing
Mm-hmm.
costs 25,000, concessions other
Mm-hmm.
costs 33,000, for a total of
Ooh.
176,750 in concessions.
Wow. Okay.
And the note said credit to buyer for loan rate and buy down.
Okay.
So my point of this is that if you're online and you're looking at comparable sales in your neighborhood, you may not know the whole story because they don't have
Mm-hmm.
what they've paid from their sale. And also, in addition to that, a lot of realtors, believe it or not, it's going to find this totally shocking, Rick. They don't report
Mm-hmm.
the information at all or
Mm-hmm.
correctly. But so you don't know what kind of costs were built into that purchase price. So I think that's why it's important
Mm-hmm.
when,
True. That's very true, by the
yeah,
way. Yes.
yeah, when you have a
100%.
when you have a realtor and the realtor is looking up these comps for you, what kind of concessions did the seller make to
Mm-hmm.
get that price?
Mm-hmm.
And Rick, is there some loans, is
Valid
there
point.
like a limit on concessions, or what's the rule with concessions with your loan?
Yeah, it depends upon the loan type and down payment, but generally it goes 6%. The lower, like a conventional 5% down is a little bit less, but but in our market, a 6% concession is a boatload of money. It's hard to use a full 6% unless you're doing a big buy down with that. If you're doing a 3-2-1 buy down, that would take up most of that. But mostly when we're doing a buy down, so either a 1-0 or 2-1 buy down, and maybe some closing costs. So generally, when you look at the average sales price, let's call it 800,000. in your example, I'm not sure what that sales price was on that listing, but on 800,000, just 3% is 24,000 right there. So
Right. Right.
that would be more than enough to cover most situations.
Mm-hmm. Mm-hmm.
And that's at 3%. You can go as high as 6%. Would that be, $50,000? And that's probably not going to be able to use it.
Right. Exactly. Because you can prepay your taxes and your insurance, but only by so much, right?
Well, you can really cover all the taxes. You can cover the prepaids and the regular closing costs and buy down. Yeah, you can really do all of that if a seller is willing to pay that much. Now, if you look at the economics of the long-term impact to the buyer, for example, a 3-2-1 buy down, let's talk about what that really means. Let's say that, just for example purposes only, let's say that the note rate was 6%. Well, 3-2-1 buy down means that the first year payment is at 3%. And then the second year is 4%, third year is 5%, and it caps out at 6%. So, and you can do that, but generally speaking, if you did that much, at some point before that 3-year mark is up, there's a high chance that buyer would probably refinance to another rate. And so that's, gets expensive. Now, in that case, by the way, people don't know this. If you do that, let's say the buyer does that, and let's say there was $15,000 left on the table that wasn't used up, the buyer gets that refunded back to them.
Oh, nice. Oh, I didn't know that.
Yeah, no one really knows that. But generally a 1-0 buy down or 2-1 buy down are sufficient in most cases. And then I would personally, if it was me, I would take, let's say it was a lot of money, I would take a 2-1 buy down and say $10,000 more in closing costs.
Yeah. Well.
That way you're getting a 4% rate starting off and a big reduction in closing costs too. So there's lots of ways to split that money depending upon the borrower and the buyer's needs and what they're looking to accomplish. So that's the discussion we have with the buyer at that point to see what's best for them. Then we just structure it.
Yeah, and sometimes people, I had an offer come in over the weekend that was a VA offer, and they were financing their VA funding fee. And
Right.
so the price increased by the cost of that finance fee.
Correct. Correct. Now, the good point with that too, Megan, is that the exception to the VA funding fee is that if the veteran has a VA-related disability or in-service disability, the VA waives that funding fee. Pretty cool.
Yeah. Yeah, it's the least they can do, right, for having a disability. So, well, good. Well, this is another good reason to, before you go out house shopping, to pick a lender, pick a realtor, and talk about all of your options based on what your needs are, because there's a lot of different ways to get things bought and paid for. Yeah, as long as the seller is ready, willing, and able.
Yes, all the time. There's lots of ways we can structure transactions these days. We have that discussion a lot with home buyers up front. It's important because one thing we don't want to do, and we know this already, but let's talk about that just for a brief moment. We don't want to have that discussion when you're making an offer.
No.
We want to have that discussion well in advance of that offer. So when you're looking at houses, we know how you want to structure it, what to expect, and then how to write that offer correctly, and not to have this back and forth counters and misunderstandings and changes throughout the course of escrow. You're really prepared going into that offer, and you can nail it down the first time, and then just get it done right.
Yeah, I like it. All right, Rick, I think that's enough info for today. I appreciate you, and we'll see you
Appreciate you, Megan.
next week.
See you next week. Take care.